There was plenty of economic optimism going into 2020 for G7 countries such as Canada and beyond. Then, as so often is the case, facts on the ground began to eat away at some of the confidence behind those earlier projections. With us now for a look as of today, Brett House, Deputy Chief Economist at Scotiabank, Linda Nazareth, Senior Fellow for Economics and Population Change at the Macdonald-Laurier Institute, Elena Cherney, Editor in News Features and Special Projects at the Wall Street Journal, and Brian Milner, freelance business and economics writer. And it's good to have you four veterans back on our program here tonight. Brett, I'd like to start with something very topical, the coronavirus. And I'd like to know what the serious implications of that and how the markets, in your view, are reacting to it.
Well, I think there's no doubt that there are serious implications and that those implications are different from the SARS epidemic in 2003, which is the nearest corollary that we have. In 2003, SARS pretty much peaked and ran its course by the end of 2 quarters in the first half of the year. We're likely to see the impact of the coronavirus on the economy being similarly transitory and similarly limited. But none of us are epidemiologists here, and really I have to defer to public health experts on exactly how far it will go. We don't know at this stage. We do know that there are 20,000 plus cases of the coronavirus infection versus about 8,000 at the peak of SARS. And we also know that the Chinese economy has changed a lot since 2003.
Well, let me follow up, with Linda on that. The numbers we're seeing here is that the Chinese economy growth rates are going to take about a 0.5 percentage point dip as a result of this, 0.5%. Is that enough to be concerned?
Well, first of all, we don't really know anything about the numbers at this point. I mean, we have some projections, but as Brett said, it's pretty early days. Second, do we trust any of the Chinese numbers, either on the virus or on the economy? I've always had an issue with that. But to your point, the Chinese economy is very different than it was. 17 years ago, there was something like 200 flights a day out of China. Well, now it's more like 700 and something. So we can't exactly compare what happened then to what is happening now. It's kind of a mirror of China's power that this virus is that much more powerful.
There's another issue, which is that today China is a huge part of the global supply chain. In 2003, it was still producing a lot of low-cost goods, shipping basically, things that weren't vital to economies. But today, those things that they make in China are vital to the global economy.
And also, China is just a bigger part. I mean, you've measured as a share of global GDP than it was during SARS. And that's going to mean that the impact of this illness on the Chinese economy will ripple through the global economy in ways that, with a magnitude that it would not have done in 17 years ago.
Let's follow up on that. I think I got numbers on that. Apparently, back when SARS hit, China's share of the global economy was 4%. Today it's 17%. So play that forward. What does that look like in terms of impact on the world economy if the economy in China does take a hit?
Well, I think Brian referred to supply chains, which is a big concern. But also we're seeing right now, one immediate impact is on oil prices. China is now the world's biggest net importer of oil, of crude oil. And so, and has refineries and deals with Saudi Arabia. So we're seeing immediately a reaction by OPEC and an effort to potentially cut back on oil supply in order to prevent an even more dramatic price drop than we've already seen in the last couple of weeks.
Brian, they are talking about priming the pump somewhat. 1.2 trillion yuan, which works out to 225 billion Canadian dollars. What can that do?
Well, they've been easing financial restrictions for a while because the Chinese economy began slowing well before this virus hit. So it means that capital is more readily available. It also means that you're going to see a big increase in Chinese debt, which is not necessarily healthy for the economy because the financial services sector is on iffy grounds. I don't think it'll do much for the economy, but I don't think this virus will have long-lasting implications for the economy either. I think, like SARS, we're looking at maybe 2 or 3 quarters of trouble. But once the Chinese refineries get back in business and they start, because they need still a lot of infrastructure spending, all that stuff's going to continue. I mean, they just put up a hospital in 10 days in Wuhan. That requires a lot of steel and a lot of copper and a lot of stuff that people are worried about the Chinese cutting back on. Well, if they're going to keep doing stuff like that, they're going to need more.
Brett, that kind of priming of the pump in China, impact it could have?
Substantial. I mean, it's not only the liquidity that's being injected into the system. The restraints on the financial system in terms of banks' ability to lend have been loosened substantially. And even before this point, the Chinese Communist Party has had in view its centenary in 2021, and the need to ensure that there is a feel-good factor connected to strong growth in the economy has been driving policy for some time. At the same time, we've had more than 40 central banks in major economies of the world easing over the last course of the year. So there is a lot of policy support globally for continued growth. And I think you have to keep that in mind too.
Let's just turn the tables a bit here. You just got back from Davos, right? You went to that World Economic Forum thing with all the movers and shakers?
The World Economic Forum thing, yes.
Yes, okay. What was the, I don't know if you're able to, but to sum up the kind of attitude that the people there had, given what we've been talking about here?
So it's really an interesting contrast because most of Davos sort of wound up on the 24th, and it was the 23rd, I think, that the big quarantine happened in China. So the mood there among executives that I spoke with and that my colleagues spoke with, there was still a great deal of optimism, which is a really interesting contrast, especially among, I would say, American executives. Pointing to the U.S. stock market, which only a couple of weeks ago, the S&P 500 index was at all-time highs. There was a really positive feeling that growth was likely to continue. Global growth still a little sluggish, but particularly in the U.S., there was a pretty buoyant sense that growth would continue.
Can I get you, Linda, to follow up on that in as much as the coronavirus, Brexit, a lot of tension between China and the United States, particularly on trade. All of those things would point to not a particularly good year to come, and yet there's this optimism. Explain.
Well, there was optimism to me that we had some resolution on trade, because that was the big question mark, especially for North America. So I think we're getting to the point where businesses were going to loosen the purse strings, and then we have this huge wild card, and we don't really know where it will end. I do want to point out, though, that in the short term, every time we get bad news, money goes into the bond markets, and we see interest rates drop. And that is a positive. Now, it can be totally offset by the negatives of the coronavirus, but low interest rates tend to stimulate growth.
Brian, what's your view on that?
Well, all this optimism that Elena found in Davos is not being reflected on the ground in terms of business spending and capital spending in the U.S. and in some other Western countries. Obviously, companies are still retrenching, and we've seen that over the last quarter of 2019. Where there was not an increase in capital spending. In fact, there's been a decrease over the last couple of quarters just in the U.S. And if they don't start spending, then they're relying more and more on consumers to carry the economy. And consumption trends are not going to continue buoyantly as long as there are high individual debt loads, especially in this country.
Well, one thing to keep in mind there, though, is that as companies have been faced with so much uncertainty and they've held back on investment spending, what they have done is shifted demand toward hiring more people. So we've had very tight labor markets in both Canada and the United States. We've started to see wage increases accelerate. And even though we are heavily indebted at the household level in Canada, that is likely to sustain consumption going forward. In the US, household balance sheets are the best they've been in 40 years. The debt service ratios, the debt burden that households have to pay hasn't been lower in any point in time since the 1970s.
Is this one of these situations, though, where the numbers and the reality on the ground may not match up? We also hear so many, and it's more than anecdotal, people saying, some people are $200 away, half the country is $200 away from being impoverished, right?
Yeah, well, those surveys, are probably telling you something different than the question is asking when it says, people are one interest rate rise or $200 away from not being able to meet their bill payments. That basically is saying no one likes higher interest rates. No one likes having to pay higher bills. But it fails to account for the fact that actually assets for most households have improved over time, and the cost of servicing debt has gone down a lot. At the same time, you've also got a situation where you can have multiple things true at the same time that don't on the surface look consistent, but in fact are. As we just noted, investment is weak at the business level, but they're hiring a lot of people, and that's largely a reflection of that fear. It's easier to hire people and adjust employment levels when things are uncertain than it is if you're investing in plant and equipment.
You wanted to add?
I think the business investment numbers are important to watch. I talked with at least one Canadian bank chief who said that that's what he's looking at, especially now that there is a deal on trade with the U.S. And also that there does appear to be some resolution or some temporary movement, peace on the U.S.-China front. And now is the time to see whether that confidence is going to lead companies to actually invest.
I know none of you is a political scientist here, at least I don't think so, but I want to talk politics anyway. Because I don't know how late everybody stayed up Monday night to watch the Iowa caucuses, only to be told nothing at all. But when they eventually get their act together, I think we're going to find out that Bernie Sanders did pretty well, and then they're going to go on to New Hampshire, and we're going to find out that Bernie Sanders is going to do pretty well. And Brian, start us off on this. I'd like to know what you're anticipating Wall Street's reaction will be to the possibility that a self-proclaimed Democratic socialist may be the standard bearer for the Democratic Party in the next election.
Well, I think that Wall Street has already made it pretty clear that they don't like Bernie and they don't like his policies.
You don't say.
And a lot of wealthy people agree with them. The fact is that even if Bernie Sanders wins in Iowa, as he is expected to do by most of the polls, and New Hampshire, it doesn't mean he's going to lock up the nomination. And there are a lot of people in the party, in the Democratic Party now, weighing this who's most electable, because they want to defeat Donald Trump. And you can tell that Trump would prefer running against Sanders, because he actually came out with a tweet last night saying this was a conspiracy against Bernie Sanders by not having his results written. So the fact is that would be his preferred opponent, because then he can go the radical left, taking over the country route. If he's up against somebody like Biden or some of the other middle-of-the-road candidates, it's going to be a harder sell.
Linda, what are you hearing and what are you seeing about Wall Street's potential reaction to a Bernie Sanders-led Democratic Party?
Well, they'll have a couple of bad days, but
just a couple?
Well, I don't know. We've had governments in this country that we've thought were radical socialists, but at some point you do need to compromise. You can't do everything that you talk about during a campaign, and ultimately, there are checks and balances, good and bad. And there's probably an economy that slows down at some point, which also is a constraint. So, I think the U.S. has survived all kinds of governments.
And one thing to keep in mind is, regardless of who the nominee is, they are unlikely to control both the Senate and the House.
That's the thing.
And that really stymies changing very much in terms of the structural change that Warren and Saunders have both spoken about.
Yes, we should remember the President of the United States doesn't actually have a lot of policy clout unless he's got his party in control of at least one of the chambers.
And sometimes even when they control both chambers, they still don't get everything through they want to get through.
Right, true.
Very much the case. Okay, I'd like to know, let's have some discussion here about whether or not you all believe Donald Trump's fiscal policies, economic policies, have led to where the U.S. is today. Can we draw that straight line? Start us off.
I think it's a very difficult line to draw. I think that the tax rollback has had impacts that we've talked about, actually, in terms of household spending and hiring. I think that there's evidence for that. Beyond that, it's much more difficult, I think, to draw a line between some of the metrics that we're seeing, the markets, and Trump. Obviously, the phase one deal with China did have an effect, but it was arguably tempering other effects that have been caused by the trade tension. So I think it's early to try and boil this down.
Interest rates are low, inflation is low, unemployment's the lowest in 40 years. How much credit are you going to give Donald Trump for that?
Well, I would judge him based on the metrics that he asks us to judge his policy on, which is essentially how are equity markets doing and how is the trade deficit in the U.S. doing. Now, equity markets have performed very well because you've had a big fiscal stimulus and you've had a big decrease in interest rates, at a time when neither of those things were needed. So we've primed the pump of the American economy an awful lot. On the trade deficit, though, Trump is unlikely to see any joy because the combination of that fiscal stimulus pulling in more imports from abroad and all the uncertainty he's generated has kept the US dollar very strong, which has also primed imports by consumers and business. So we're not going to see a reduction in the US trade deficit. It is inconsistent with the policies he runs. And that's why we're likely to keep seeing more trade and protectionist battles ahead over the next year and even more intensively after the US elections.
Linda, this is what I want to know. Basically, they're running $1 trillion deficit in the United States, the government deficit, not the trade deficit, the government deficit. The net cash requirement to run the government of the United States is $1 trillion in the hole that the government is borrowing in order to fund its operations. So the economy is doing great, but is it just on a sugar high?
Well, first of all, I would question whether the economy is doing as great as Mr. Trump, President Trump, says it is. First of all, even a metric like the unemployment rate doesn't mean what it used to mean. It means, yes, people are working, but are they contractors? Are they part-timers who want to be full-time? Are they working a couple of part-time jobs? It's not the same number it was 40 years ago. Second, yes, sugar high, cut taxes, things look better. But, you're not cutting them every quarter, so that comes back. Third, absolute disaster on trade. The idea of picking fights with your allies, including Canada, where was the logic in that?
A lot of red state Americans like that policy.
And they're not doing better. The divides in the U.S. are only growing.
Well, I know you want to go, but one question, Shirley, is over time, do these policies, do the trade policies result in bringing back the jobs and the industries that they were allegedly, and the impact on the trade numbers? I mean,
do we know the answer to that?
I don't know that we know that answer yet.
Some of those industries are gone forever. Those
Yeah.
manufacturing sector jobs that are so dear to so many hearts.
You mean
aren't
the
coming
coal
back.
industry's not booming? I can't believe that.
Yeah, and the early signs are that these policies don't bring the jobs back. The little blip that we saw in U.S. steel production has more or less been erased, and we've actually seen closures rather than additions to production. To the extent we've seen some reshoring of jobs or parts of the production chain that went to China maybe 15 or 20 years ago, they're not coming back to the US, they're coming back to Mexico. And thirdly, if we look at the changes to NAFTA that were brought in, which are marginal, it's really NAFTA 2.0, not a big revision of the trade agreement. Most of those things make North America less competitive rather than more competitive. So they're likely to push production overseas rather than bring marginal production here.
Brian, I want to hear from you whether you think the U.S. economy right now is doing relatively well because of Donald Trump's policies, or is it simply experiencing $1 trillion sugar high from deficit spending?
Well, it's not just a sugar high, and it's certainly not anything Donald Trump is doing because, yes, he got a phase one deal with China, but he triggered the coal crisis in the first place. The fact is the U.S. economy is doing pretty well, has been doing pretty well since 2014 when Obama was the president. That's when you started to see job recovery. That's when you started to see investment recovery. And that's when you started to see consumers' spending increasing. Did the tax cut help on the spending side? A little bit, but it didn't help on the business side because most of the money went to buy back shares. It didn't go into investment. And that's still a problem for Trump. Plus, when you look at manufacturing in the U.S. has actually been in a slump for about the last 6 months. You could say that manufacturing is in a recession in the United States. And that's partly triggered by Trump's own trade policies. So no, I wouldn't give him any credit for this stuff.
Having said that, is there any question in your mind that Wall Street wants Donald Trump reelected in November?
I'm not sure I can answer that question. I haven't polled Wall Street, and I think that, it depends. We still have to see who the Democratic candidate is. I think we're a long way from seeing, the end of that race. And I think if, you're positing that it's Trump versus Sanders, that's one question. Mm-hmm. Trump versus somebody else might be a different question. I don't know if anybody else wants to.
On that, Brett, if it's Trump versus Biden, somebody more moderate, maybe Wall Street's a little more evenly spread. I don't know. The conventional wisdom is Wall Street wants him back. Is that wrong?
It's hard to say. I think it depends on who you're talking with on Wall Street, and I think it depends on the time horizon that you're speaking of. If you look back at the 2016 election when Trump was elected, going into the day of the election, when exit polls started indicating a Trump victory, you saw a massive sell-off.
Yeah.
And within hours, the market changed its mind and then rallied. So, I'm not sure equity markets and bond markets are necessarily the best indicator of what is good for the U.S. economy.
What do you think, Linda?
I agree. The problem with Wall Street wanting or not wanting a candidate is that's a very short-term wanting. It's not necessarily the right thing for the economy in 2 years or 3 years, or 5 years or 10 years. Let's remember we're at this sort of pivot point where we are talking a lot more AI. We are talking a lot more changes in productivity for efficiency, things that will affect jobs. It's a major, major shift that's happening. And I'm not sure the thinking in the markets is really long-term enough.
Okay, let's come home. Brett, I wonder if you could get us started in a bit of a discussion about the economic and financial factors you see out there affecting the Canadian economy over the rest of 2020, and perhaps what you see, no pun intended here, in the pipeline to help us deal with some of that.
Well, I think the most salient thing right now is that we saw a lot of weakness at the end of 2019, where our models are tracking zero growth in the fourth quarter of last year and a very soft handoff into this year. And that leads us to think that the Bank of Canada, which has really resisted easing monetary policy, one of the few major central banks that has, is probably going to move toward a couple insurance rate cuts this year. Now, of course, the worry is with incredibly indebted households that that's going to trip off even more borrowing. And the fact is that horse has already left the barn in some ways. We saw a huge increase in mortgage borrowing rates, and then at the end of the year, consumer borrowing. And in many ways, that reflects the point that you made that, capital markets have already brought interest rates down, particularly at the sort of 5-year term that is most important for mortgages. But very short-term rates remain a bit higher. And so if the Bank of Canada were to bring interest rates down, that would provide a little more cushion for business, which is really buffeted by all the uncertainty around trade, Brexit, coronavirus, and make it a bit easier for the businesses to fund themselves at the short end.
Brian, what do you see?
Well, I think that's true, and I think also that we should be aware that the Canadian economy is not performing evenly across all the provinces. We see good prospects for continued growth in BC, Quebec, possibly Ontario as well, but not in places like Alberta and Saskatchewan, where they continue to deal with the problems plaguing resources and plaguing shipment of oil, and that's going to continue.
And Linda, even, you can't even say Ontario. You really have to say Toronto and Ottawa, and, Toronto area and Ottawa. The rest of the province is certainly not enjoying the kind of economic conditions we're seeing here, right?
And, I don't think we should take it for granted that Toronto will do well if the U.S. economy goes down. We already are hearing that auto production is being affected by the coronavirus and Apple and other things, and that will spread through this part of the economy too. So the Bank of Canada is weighing a lot of different things. I don't think they can take anything for granted.
We got growth rates in the province of Ontario, and then in Canada, I guess in general. What are we looking at? Like less than 2%, right? Since when was that considered terrific?
It's not. It's a kind of meh economy, but it's also not a recession. And you've had, people sounding this recession alarm for 6 or 7 years, saying we're on the edge of it, and they've been consistently wrong. And it's for a couple of reasons. One is that you have had that concerted policy support, both from fiscal and monetary authorities. And, as I mentioned earlier, when you look at the finances of the average household in the U.S. and the average business, they're in pretty good shape. And so, we've been buffeted by all the uncertainty from White House trade policy, but the fact remains we benefit from being right beside the United States, it being our biggest trading partner, and generally for every percentage point of growth that you get in the US, we get about half a percentage point here because of the demand for our goods and services.
So let me follow up with you on that. We've now got whatever you want to call it, NAFTA 2.0 or USMACA or what?
See the other one with the...
Yeah, what's the one that starts with when we put Canada first?
CUSMA.
CUSMA. Anyway, some of these acronyms get a little ridiculous. Do we have every expectation now that this deal has been signed and is done that it will be a net positive improvement to the Canadian economy?
Well, I think that's the question mark, and really what perhaps the Bank of Canada is waiting to see is whether there's business investment that follows and whether this period of uncertainty ends, whether at least in the immediate that this is enough of a strong enough agreement, a good, positive enough agreement that companies start to once again invest. I think over the long term, Brett raised some interesting questions about whether the deal actually damages North America as a whole, and whether, in fact, both the U.S. and Canada, well, and potentially Mexico, will all suffer as a result. I assume you're talking about some of the content.
Yeah, around autos,
Yeah,
where it does put heavier restrictions on auto production for the entire continent, and as a result, make producing here a bit more expensive. I think the most salient thing, though, about the USMCA is that it preserves the 98 to 99% free flow of goods between Canada, US, and Mexico that we have under NAFTA. So, the changes in the new agreement are pretty marginal. I wouldn't call them an improvement broadly, but the real victory is that we didn't see much of an erosion in what we already had.
And it's done.
It's done. At least we have one uncertainty out of 2020. Lots more left, though.
But do you see it as potentially unleashing some kind of new era of wonderful economic activity between Canada, the United States, and Mexico?
Sadly, no. It's more or less, as Brett said, what we had before. I was really quite concerned that we were going to shut down what we had. I don't think this economy, Ontario or anybody else, would survive very well. So it's one thing that was a positive. But again, 2020 is starting in a way that we didn't really expect. And
I note that Premier Ford is going to be going stateside to try to drum up business here. Do these trips have any impact?
Well, this is, of course, something every provincial premier always does, and they don't just go to Washington. They go with they used to go to a lot to China, of course, and Japan, but these days they're not going to do that. It helps to show the flag, but if he's expecting a ton of investment in Ontario because of these trips, that's not going to happen.
Well, the idea is he wants to get America out of its Buy America obsession. That's what he's trying to convince them to do business here, as opposed to deal with this Buy America thing.
In the Trump era, that's not going to happen either. So I think that it's always good to show the flag and remind people that we exist, but it's not going to get GM to reopen its full production in Ontario, and that's the kind of thing that he needs done.
You got a view on that, about whether or not these trips to try to convince American governments not to only buy American can have an impact?
I think that Brian's right, and that as long as Trump is the president and Buy America is the emphasis, it's not like Canada's got a special exemption. And that's kind of what we saw in this negotiation over NAFTA. We thought that we had a special relationship and we're special allies, but I don't think that necessarily holds in the America First world.
And I think, one of the lingering concerns that will keep business investment damp is that, we saw the Trump administration reopen the new revision of NAFTA for an entire year after it had already been concluded. It threatened tariffs on Mexico if it didn't align its immigration policies and actions in the way that it wished. So it's clear with this White House, a deal isn't a deal. And so long as a deal doesn't provide certainty, investment is unlikely to be unleashed as a result of it in a big way.
In spite of what all of you are saying here tonight, Brian, I want to put this to you. Apparently, Export Development Canada released a report this morning showing that the Trade Confidence Index is at an 8-year low. Why would that be the case, given all of the celebrated victories we're here discussing?
Well, we can celebrate the arrival of NAFTA 2.0, but everybody in the export business knows that it's not going to mean very much in terms of increased business, because they're already doing as much trade as they possibly can with the U.S., and the key is how well does the U.S. economy handle all these huge headwinds going forward, and the worry is that they won't handle it very well, and that demand will drop from the key U.S. markets, and that's going to affect Canadian trade. So you can see why confidence would be lower, especially given what's happening now with China, because China is hugely important to Canadian resource producers. They're the world's biggest buyer of copper. They're the biggest buyer of imported oil, but they're also one of the biggest consumer markets in the world. So if that has an appreciable decline, it's going to affect Canadian exporters directly.
I've got numbers here, Linda, that say investment in plant and equipment by Canadian businesses has dropped 20% over the past 5 years, the worst performance in more than 5 decades.
Well, part of this is about the Canadian dollar. Remember, we bring in a lot of investment goods, so there's always a let's wait till the dollar's stronger kind of attitude from companies, so that's part of this. Part of it is that we do have business caution. It has not really gone away. Even when some of the numbers have looked better, you still have businesses worried about their market share. It's a very competitive international economy, and it's not changing.
You want to follow on that?
Yeah, no, I think, again, we keep coming back to this question of business investment. And this is what I heard from, executives and some Canadians at the World Economic Forum, that they're watching now to see whether these trends start to change, whether the uncertainty. But, the point that you make, Linda, about this being a 5-year trend does, that's worrisome. And presumably that long predates any of these trade uncertainties and points to something more structural and much more potentially problematic.
Well, let me put this to you then, Brett. Again, we see Canadian investment in intellectual property products has fallen. And if we're trying to be a more productive country, how exactly is that good news?
Well, it's not great news. And I think I bring it back to what are the big components of GDP, the total output in an economy in a year. You've got private consumption, and we know households are more or less tapped out with the debt levels that they have here. We've got all the uncertainty in the global economy, which is dampening trade and exports. And we also have this uncertainty dampening investment. So what that leaves as a source of growth in Canada really is fiscal policy. And we're not going to see a turnaround in things like intellectual property investment or even just plant and equipment investment without a little more support from the fiscal side. And so I would expect in the budget coming from Morneau in March that we are likely to see increased spending over and above what we already anticipated from the Liberal platform, because that really is the only thing that is going to help lift some of that hedge that business is feeling on investing in the absence of a change in policy from the White House or a more moderate approach to Brexit in the UK or a real fundamental change in the broader slowing in some other parts of the world.
And Brian, what about pipelines? Are we going to see any change in the approach to pipelines in the country?
Well, we need to see one, at least from Alberta's point of view, and also BC, because if you can't get your resources to market, then you're going to have continued problems in the core economy, because that is the economic engine that drives Alberta. And environmentalists may be very happy to see no pipeline construction, but you're talking about a huge problem for the economy going forward if they can't get these products to market. The products are still needed, the demand is still there, although it's declining, and they simply have to figure out how to do that. Now, they're going to increase rail shipments, they're going to increase truck shipments, they're going to take the cap off production because the Alberta government has already promised to do some of that. So that means we'll see a little more production, but how do you get that stuff to market? You've got to build pipelines, and pipeline construction is a huge job creator, and it's also a huge income creator for the provinces involved.
I'm just curious, when you travel the world, like when you go to Switzerland or when you go to New York or wherever, and you talk to people about pipelines and the difficulty with which this country builds them, what kind of reaction do you get from people?
Well, it's gotten more complicated because the conversation around energy and around oil and what will be needed, and obviously, I mean, Brian and I worked together 10 years ago. It seems like, I can't believe it's that long, but when the oil sands were booming, and now obviously there's been a huge pulling back, retrenchment from the oil sands by international players, because it is a more expensive place to operate, and also it's more carbon intensive. So we are seeing, I mean, Canada has definitely been punished in several ways. First of all, by the pipeline and the market access issue, but also it's been more difficult for Canada to compete in a time when there's plentiful US shale, to win investment, and at a time when there's a lot more consciousness about long-term carbon footprint by energy producers. So it's a more complicated question than it was a decade ago.
And how about, Linda, climate change, impact of climate change on any of the things we've just been talking about?
Impact on everything. I give a lot of presentations to business groups, all kinds of groups. It used to be somebody would ask a question at the end about climate change, maybe. Now I put it into every single presentation because it's relevant to every industry, whether we're talking about energy, but also if we're talking about travel or a consumer industry or housing, everything. It's a relevant part of this. And it's this huge issue for any oil-producing province, that they have bad PR right off the top.
If businesses are waking up more nowadays to this issue then, Brian, is there an argument to be made that these pipelines ought not to be built, and a lot of this stuff's just going to have to stay in the ground.
Sure, if you can tell me how economies are going to function over the next 20 years just on renewable energy when there isn't enough of it to meet the demand. And the more electric cars you produce, the more demand there will be because somebody has to produce the electricity. So how do you do that if you don't have natural gas or oil to do this sort of thing?
Well, we've decided in this province it's nuclear and renewables. That's the split we've got here.
Well, the fact is that it would be in the short term and even in the medium term, the best thing you can do is get the stuff you've already produced to market. Now, the best thing Alberta could have done many years ago is build its own refinery capacity. That would have solved a lot of these problems, but they didn't do that.
Too late.
It's even harder to get a refinery built now than a pipeline. So yes, it is probably too late.
You want to pick up on that?
Yeah, I mean, I do think that we are seeing many, many signs that climate change, sustainability issues are front of mind for business in an actionable way that wasn't the case some years ago. I think that, we saw that at Davos. We see that, though, in announcements that companies are making about products going forward. I think, though, that, and I actually don't question that something is changing. I think that something for business and for investors is, in fact, changing around climate, and they're taking it seriously. However, there's a couple of different time horizons, which Brian sort of alluded to. There's what companies are doing now in order to change their practices, but there's the fact that we need energy and fuel right now. And look at what happens immediately to the price of oil when something like the coronavirus happens. That illustrates, the demand and the need for this fuel. So I think, and actually, Rex Tillerson made some comments apparently this morning somewhere in the U.S. about how
it's the former Secretary of State,
the former
head of
Secretary
Exxon.
of State and former CEO of Exxon, about how, yes, okay, fine, we're seeing this decline in stock prices of energy companies and demand for fuel, but for oil. But in fact, it's going to be a long, slow, steady decline because the world still needs this stuff.
That's going to be the last word to the Wall Street Journal today on our program. I want to thank everybody for coming on. Brian Milner, the freelance business and economics writer. Linda Nazareth, Senior Fellow for Economics and Population Change. That's a great title, Linda. At the Macdonald-Laurier Institute. And on the other side of the table, Elena Cherney from the Wall Street Journal. Brett House, Deputy Chief Economist, Scotiabank. Great to have you all on TVO tonight. Thanks so much.
Thank you.
The Agenda with Steve Paikin is brought to you by the Chartered Professional Accountants of Ontario. CPA Ontario is a regulator, an educator, a thought leader, and an advocate. We protect the public. We advance our profession. We guide our CPAs. We are CPA Ontario. And by viewers like you. Thank you.